Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to a live stream. We have got to talk about inflation today because there are some signs out there that this is about to get much worse. Why inflation is going to be headed a lot higher very soon. Why the Fed is incapable of fighting this. Those are the topics we will be discussing today. And I want to start off with this video here that we're looking at from a user by the name of Chicago One Ray on X. And I'm not going to play the video for you because of some of the language that this guy uses, but I'll sum it up for you. So he's a trucker. He's a Trump fan, as you can see from his hat there. And according to this video, which now, as you can see, it was published on February 16th, it's gotten 5.9 million views so far. And according to Chicago One Ray, he's been on the radio talking with other truckers as he drives around on his trucking route. And he believes that come Monday morning, truckers are going to begin boycotting New York City. Now, this is in response to this civil suit that a New York judge just ordered Donald Trump to pay over $355 million for fraudulent business practices in New York. Now, I myself, I'm not extremely familiar with the nuances of this case. I don't really have a dog in the fight as far as that goes, but truckers who, according to Chicago One Ray here in this video, has received quite a bit of attention, predominantly support the former president. And if they decide to begin boycotting New York City, that's going to have a huge impact on the cost of goods there. Something like over 70% of goods within the United States reach their destination via trucking. There's a lot of people in New York City. They buy a lot of stuff. They eat a lot of food. You could see a huge spike in prices if there is a supply chain disruption of this nature. Now, the other thing I want to point out is, while, a disruption of supply to New York City could have some small impact on inflation locally, keep in mind that we are in the beginning of an incredibly divisive election year. It's only February. And if we're already seeing internal supply chains, why do I have my calculator open? Let me close that for you guys. Sorry about that. If we begin to see internal supply chains weaponized as a result of political upheaval in the United States, that could be a big problem for supply chains and for the cost of really just about everything. I see some folks in the chat saying they are truckers. If you're a trucker, put it in the chat. Let me know any information you have regarding this potential boycott. But look, here's the thing. Internal supply chains are not the only ones that are being disrupted. While this could be a big problem, there are some things that are much more guaranteed, such as the continued disruption of supply chains in the Red Sea, one of the world's most important trade routes. Yesterday, we had confirmation that Houthi missile strikes have hit a oil tanker, an India-bound oil tanker. According to this report here, the U.S. State Department announced that a Panamanian-flagged tanker carrying crude oil bound for India was struck by a missile in the Red Sea. According to reports, the missile launched from Yemen hit the MT Pollux on its port side. The vessel, according to this report, sustained minor damage and confirmed that the crew was safe and unharmed. However, was this vessel able to continue to its destination? We're really not sure about this. Will this dissuade other oil tankers from utilizing this trade route? Almost certainly. And, the price of crude oil is reflecting this. This is the one-year chart here of crude oil, and you can see that it's up more than $10 from its lows in December, up almost back over $80. Now, if there's one asset that is correlated with inflation in our economy, it is crude oil. It is the lifeblood of our economy. It fuels the trucks that deliver the goods. It touches more products than just about anything else. And as this price moves up, we are going to see inflation continue to move higher. And it's not just for oil. I mean, this is a shot from the Washington Institute here of the trade route, this one in the dotted red line here through the Suez Canal, which is being disrupted. A much shorter transit time rather than vessels having to go around the south end of Africa here, going around the Cape of Good Hope. This is adding a lot of time, adding a lot of expense to the cost of shipping just about anything in container vessels. And again, this is a effect that is going to have some lag time. We haven't felt it completely yet, but we are beginning to see the effect of this. You can see that in this CPI data that was just released for January. You can see here, this is a chart of the monthly increase in inflation. Now in October, we were hearing from the Federal Reserve, disinflation is here, inflation is coming down. You know, they were starting to talk about rate cuts, how everything was going according to plan, except, look, November, December, now January, the month-over-month rate of inflation is ticking higher, and this is just getting started. I mean, if the price of crude oil continues to move higher, if internal supply chains in the United States are disrupted by a trucker boycott, a politically linked trucker boycott, and look, I'm not judging the truckers for this here. I'm not passing judgment either way. This is just something that we need to acknowledge is a real problem for moving goods around. And, you know, we saw the effect of disrupted supply chains in 2020, 21, 22, when we saw the rate of inflation spiking. Now, of course, that had a lot to do with dollar creation, too. That's still continuing. I mean, the amount of dollars that have been printed, there's still a huge number of them in the system. The Fed balance sheet's still over $7.7 trillion. But you combine that with disrupted supply chains, and we are going to have a real problem. And I want to talk about why the Fed is not going to be able to fight this, but also I want to take a quick look here at the price of silver. You can see there was this huge drop-off in the price of silver following that January CPI data that was released. This is a 5-day chart of silver. However, you know, you can see here that the price of silver now is higher than it was prior to that data being released. What's the dynamic at play here? Well, hotter than expected inflation number comes out. Everybody thinks, oh no, the Fed's not going to be able to print. They're not going to be able to cut rates. But it looks like markets may be coming around to the fact that no matter how high inflation gets, the Fed is going to be printing quite a bit of fiat currency. That's likely why the price of silver is up something like 7% from its lows just a few days ago following the release of that CPI data. We've had a significant rally in the price of silver, and this, I think, is going to get much more steam behind it once it becomes clear to investors at large that the Fed has no chance of fighting this inflation with continued rate hikes. They are going to have to cut rates no matter what happens. If you want to get some silver before that happens, make sure you check out today's video sponsor, SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Now, there was this article from Bloomberg just a couple days ago about how Larry Summers is now saying that there is a meaningful chance that the Fed's next move may be a hike. This is a former Secretary Treasury, Larry Summers. He says that persistent inflationary pressures evident in the latest data suggest there's potential for the Federal Reserve to the next move to be a interest rate hike. He says, quote, there's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards. The Fed is going to have to be very careful. Well, listen, there is not a snowball's chance in hell that the next move is going to be a hike. It is not possible the Fed will collapse the entire economy if they do this. In fact, they risk collapsing the economy simply by avoiding cutting rates and forestalling that. We're going to talk about why here through the rest of the video here. A couple of reasons why it's very clear that the Fed will not be able to hike rates as Larry Summers suggests here. However, it is important to note that this sentiment that the Fed may be cutting, or rather they may be hiking next, is creating an opportunity for us, I think, to get into assets like gold, like silver, that will take off once it becomes clear that that's not a possibility. So let's talk about this. This is from the Korea Herald. This is headline, U.S. commercial property crisis looms over Korea. We've talked extensively on this channel in recent live streams about the commercial real estate crisis, which is looming here in the U.S. One of the main reasons why the Federal Reserve, rather than hiking, is going to have to get out there and cut rates substantially. Well, now this is becoming a truly global crisis, and this will put even further pressure on the Federal Reserve to ease rates, because the problem is that the downturn in the U.S. commercial property market has already hit banks in New York, Japan, and Europe. It's now beginning to loom over South Korea with around 1 trillion won, that's about 750 billion US dollars, in losses already confirmed by the big financial conglomerates, according to this report from the Korea Herald. The original principal of 10.44 trillion won invested via alternative investments other than loan receivables, such as beneficiary certificates and funds, by 5 big firms in South Korea, is now valued at 9.34 trillion won, reflecting a 10.5% loss. Now, that loss is going to continue to grow, as will the losses of banks such as New York Community Bank Corp., who saw a massive sell-off in their share price, which has bounced a little, but it has not nearly recovered to where it was just 2 or 3 weeks ago, following the revelation that they've lost significant amounts of capital on these commercial real estate investments. Well, as we can see here, the cracks are continuing to show in this sector. The losses are continuing to mount. And eventually, this is going to be a situation where the Federal Reserve is forced to cut rates to prop up the valuation of these underlying commercial properties, which back up all of this investment and all of these loans. Here's another one from Bloomberg that I think is kind of interesting, relating to the commercial real estate market. And this is in Europe. In Europe, commercial real estate valuations are coming under additional pressure due to carbon footprints and regulations which are being put into place in Europe. So it's not just the Fed keeping rates elevated, but this is a problem which is being exacerbated by climate legislation in Europe. According to this report, real estate companies are facing a major blow to asset valuations as evolving European requirements drive investors and bankers to cut their exposure to buildings with a big carbon footprint. So this is the last thing that the commercial real estate sector needs, but this is exactly what is getting served up across the pond here. The issue has increased the possibility that property owners' assets will end up stranded, devalued by the impact of climate regulations. The European Union estimates that about 85% of buildings in the bloc were built before 2000. Of these, 75% have what they call poor energy performance. The EU has set a goal of cutting emissions in the building sector by 60% by 2030 and completely decarbonizing it by 2050. At 42% of energy consumed, buildings are the single largest energy consumer in Europe. So, climate insanity now causing the valuations of these properties to plummet, as well as the fact that interest rates remain elevated. That's a problem because buyers can't finance these properties. A property that gets its valuation from a loan that is financed near 0%, well, when that loan matures and rates are now closer to 5% or higher potentially for commercial properties, that's a huge problem. It means you can't pay as much for the property because the financing terms aren't as easy. I mean, it's very simple. And almost all of these commercial properties in the United States, it's about $4.7 trillion worth that the banks have exposure to. All of the valuations were created, they were inflated when the Fed was keeping rates near zero. Now, if the Fed doesn't want the banking sector to collapse, like New York Community Bank Corp threatened to just a couple weeks ago, they're going to have to cut rates. And if they hike rates, all bets are off. Now, here's another reason why the Fed simply cannot hike rates and why they're going to have to cut. The U.S. national debt, which now sits at $34.241 trillion. It's fun. Every time I do one of these live streams, the number is, several billion dollars higher, right? Because we're racking up debt at an incredible pace. Something like $10 trillion of U.S. treasuries are going to have to be issued this year when you combine the deficit with the almost $9 trillion worth of treasuries that are maturing. All of those are going to be financed at higher rates unless the Fed gets out there and begins cutting rates. And, how do they cut rate? How do they lower the yield on U.S. treasuries? Well, cutting rates might help, but I suspect they're going to have to get directly into the market and buy up a large number of those treasuries, which are rolling over, and the new ones that are being issued because of the massive deficit spending. That means they're going to increase their balance sheet. That means inflation is going to get a lot higher. But there's another reason that the debt is going to continue to balloon this year and deficits are going to continue to skyrocket. That is because in Ukraine, they're beginning to suffer some serious losses. And imagine this, we're going to be sending them billions of dollars more. This one from The Hill, Ukraine says forces are withdrawing from Avdiivka. I'm sorry, I'm messing this up. A critical city in eastern Ukraine. Avdiivka, I don't know. I'm having a hard time with it. Anyway, it's probably an easy thing to pronounce. Avdiivka. I don't know. I'm saying it wrong again. Anyway, I'm going to stop trying to pronounce this and we're going to talk about what's going on. The Ukrainians are now withdrawing from this besieged city as the Russians roll in. And, what are we hearing from the Department of Defense? Officials say that without U.S. funding, Ukraine's defense will likely collapse, despite generous military support for Ukraine by allies and partners. Unless Congress passes the Defense Department's supplemental funding request, Ukraine will not be able to defend itself against Russian aggression, a senior defense official told the news media today. We have got, according to Politico here, bipartisan lawmakers unveil a $66 billion military aid and border alternative. Now, this is a alternative to the $95 billion aid package that was passed earlier this week by the Senate. The House counterproposal removes tens of billions of dollars in humanitarian economic aid for Ukraine and Gaza included in the upper chamber's bills, and it leaves the military portion that was in the Senate bill. So no humanitarian aid for Ukraine or Gaza. And look, I'm not saying we need to be spending billions on that either, but we're definitely going to be sending them the military aid. You can be sure of that, in part due to lobbying, I'm sure, from the military-industrial complex and also from the apparent need by the current folks in charge to just start and maintain as many wars as possible around the world. Now, some people in the chat here are talking about specifics about the Ukraine war. Was this a big victory for the Russians? Are they going to win? Are they going to lose? Look, the bottom line here is that this conflict is going to continue, and tens of billions, hundreds of billions of dollars are going to continue to be poured into it. No matter which way this goes, unless the conflict ends, which there seems to be no sign of that anytime soon, then, there's going to be a huge amount of money poured into this. I wouldn't be surprised if we see NATO troops moved into Western Ukraine, and then we see that frees up some more Ukraine soldiers to move over to the east. I mean, there's huge risks of escalation here. At the very least, we're going to be sending over vast quantities of cash, and this is going to become much more expensive. Of course, in Yemen, where they're continuing to launch strikes against the Red Sea, we've been told by the U.S. that the retaliatory strikes on their positions will continue until the Red Sea attacks stop. But, that's not stopping, right? Missile attacks on oil tankers as of yesterday. So both of these conflicts are going to continue to soak up huge quantities of borrowed money. When they talk about funding these things, you got to remember, we don't have any money. It's all being borrowed. It's all deficit spending at this point, to the tune of trillions of dollars per year. So, when you're borrowing that kind of money, the Fed is going to have to cut rates. The interest on the national debt has already exceeded $1 trillion. How long can that persist? I mean, it's the third largest item on the budget. It's bigger than the defense budget, the interest. So how sustainable is that? Put a 1 in the chat if you think we can endlessly do this. Put a 2 if you think that mathematics will win out and this is going to have to come to an end at some point. The only way you can sustain this kind of borrowing and this kind of debts and deficits is to slash rates. And that is what we are going to see. When we do, well, the price of gold and silver, I think, are going to take off. Inflation's going to head much higher. And before that happens, you want to get prepared. So let me know what you think about this in the comments down below. Oh, don't leave yet. Actually, I had one more thing I wanted to talk about. One more slide queued up here. We have U.S. Treasury interest rates. Now, this is related to the interest on the national debt. Just wanted to point out that this yield, it's moving up significantly. In October, it kind of peaked. We had rates almost at 5%, clearly unsustainable and had a lot of problems. That was when we got the whole disinflation narrative from the Fed. They started talking about rate cuts. In December, Powell basically told us that we were going to get several rate cuts in 2024. Now that narrative has shifted. What is happening now? The yield on U.S. Treasuries is moving back up That's going to lead to higher costs for all of this borrowing, nearly $10 trillion coming this year of treasuries getting rolled over and new ones being issued. Fed's going to have to intervene here to cut rates. Anyway, let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.